Welcome to Wall Street Weekly.
Thank you. It's quite a week to be here.
Yeah, imagine getting a perfectly clean bill of health from your doctor. Like, your blood pressure is down, your cholesterol is perfect, and you feel great. But the moment you walk out of the clinic and into the parking lot, you see your car completely engulfed in flames.
Right.
That jarring, just whiplash-inducing contrast is exactly what happened to the global financial markets during the week of July 13th to July 17th, 2026.
It really was.
So our mission for this deep dive is to decode what was a truly historic, highly volatile, and heavily news-driven 5 days in the global economy.
Yeah, and there's a lot of noise to sift through.
Exactly. We are going to extract objective insights and actionable strategies from that noise. And we are doing this for you, whether you are, a retail investor checking your retirement allocation on your lunch break, or you're an institutional portfolio manager trying to navigate these massive capital flows.
Because it's a week that fundamentally demands our absolute attention. We aren't just looking at a few numbers ticking red or green on a screen here.
Right.
We are looking at a structural collision of macroeconomic forces. Honestly, this week will likely end up as a case study in advanced finance textbooks.
I completely agree. And the overarching theme that kept jumping out from our stack of sources, the daily summaries, the economic reports, the market data, is this concept of a massive valuation tug-of-war.
That's a great way to put it.
Yeah, like if you picture the global equity markets as this thick, heavy rope, you had incredibly optimistic domestic economic data pulling hard on one side. We finally saw cooling inflation offering real, palpable relief to the U.S. economy.
Right, the data was stellar.
But on the other side of that rope, pulling with immense violent force, was a severe geopolitical supply shock in the Middle East. And just to, complicate the physics of this tug-of-war even further, a late-week structural correction in the biggest technology stocks on the planet jumped in and started yanking the rope in a completely different direction.
Which is precisely why dissecting the mechanics of this specific week is just so critical for the listener's portfolio strategy. We are witnessing a fundamental regime change in how risk is priced.
The regime change.
Yeah. For the better part of the last year, we operated in this unified, tech-led momentum market.
Right.
That was an environment where you can simply buy a cap-weighted index fund, go to sleep, and wake up wealthier because a handful of mega-cap technology stocks were carrying the entire market upward.
The easy money phase.
Exactly. But between Monday and Friday of this week, that easy momentum died. We slammed headfirst into a highly selective stock pickers environment. The underlying rules of engagement for capital allocation completely changed.
Well, before we start turning the gears on how specific sectors and asset classes performed, we do need to establish a very clear boundary for our analysis today.
Yes, absolutely.
We are going to be discussing the severe military conflict that escalated this week between the United States and Iran in the Strait of Hormuz. We are strictly analyzing the economic, the supply chain, and market impacts of these events based purely on the provided financial sources.
We have to keep it objective.
Right. We maintain absolute neutrality here. We are not endorsing, criticizing, or evaluating any political or military viewpoints. Our focus is entirely, 100%, on how these geopolitical shocks repriced risk and moved capital in the global markets.
That is a vital distinction to keep in mind throughout this deep dive. We are observing this crisis exclusively through the lens of capital flow, asset valuation, and raw material pricing.
Okay, so to understand why the tech sector ultimately crashed by the end of the week, we first have to understand the oxygen in the room.
The macro setup.
Exactly. We have to look at the two massive macroeconomic forces wrestling for control of the narrative. Let's start with the domestic economic data that hit the tape on Tuesday and Wednesday because, in any normal week, this would have sparked a historic market rally.
Oh, without a doubt. You are referring to the Consumer Price Index, or the CPI report for June 2026, which came out on Tuesday, July 14th.
Right.
If we strip away the market chaos and just look at the mechanics of this specific data release, it was a phenomenal report for the underlying health of the U.S. economy.
It really was.
Yeah, headline CPI, which includes, everything consumers buy, actually fell by 0.4% in June. And that deceleration brought the annual inflation rate down to 3.5%.
Okay.
But the metric that institutional investors and the Federal Reserve scrutinize most intensely is core CPI.
Right, because core CPI removes the highly volatile components from the basket. It strips out food and energy prices because those can They can swing wildly based on a bad harvest or a localized oil refinery outage.
Correct, exactly. By stripping out food and energy, core CPI gives us a much clearer, much less measy picture of underlying sticky inflation trends.
Things like shelter and medical care.
Yeah, shelter, services, exactly. And for the month of June, the month-over-month core CPI remained completely flat. It was 0.0%.
Yeah.
That is a remarkably cool number in the context of the last few years, and it dragged the annual core CPI rate down to 2.6%.
Let me put this into perspective for everyone, because a 0.0% print is the holy grail for a central bank trying to execute a soft landing.
It really is.
Think of the Federal Reserve's monetary policy like the braking system on a massive freight train. For the last couple of years, the Fed has been aggressively applying the brakes by raising interest rates, trying to bleed off the excess speed, the inflation that was overheating the economy.
Right.
When we see a core CPI of 0.0%, it tells us that the friction from those interest rates is working perfectly. The train is slowing down to a safe, manageable speed, but crucially, the wheels haven't locked up and the train hasn't derailed into a recession.
Yeah, that's a perfect analogy. The mechanical transition from a high inflation environment to a stable price environment appears to be holding steady.
Yeah.
And, that data point wasn't an isolated incident. The very next day, on Wednesday, the Producer Price Index, or PPI, was released.
Right.
The PPI measures wholesale inflation, the prices that domestic producers receive for their output.
So the cost of goods before they reach the consumer shelf?
Yes, the factory gate prices.
Yeah.
And our sources indicate that PPI unexpectedly deflated in June.
Deflated. Not just slowed down, but went negative.
Exactly. When producers are paying less for their inputs and charging less for their wholesale outputs, that acts as a leading indicator. It mechanically suggests that consumer prices further down the supply chain will likely continue to cool in the coming months.
Okay, but wait, I have to push back here because this is where the logic of the market seems to just break down.
Okay, let's hear it.
If inflation is cooling so beautifully and producer prices are actually deflating, shouldn't growth stocks, specifically the massive tech companies, have been the biggest winners this week?
Well,
I mean, we know that tech valuations are highly sensitive to interest rates because their value is based on massive future cash flows. When inflation drops, the expectation is that the Fed will cut interest rates, which mathematically makes those future tech profits worth more today.
right, the discount rate.
Exactly. So with this incredibly bullish inflation data, why didn't the Nasdaq skyrocket? Why did it ultimately crash?
That paradox is the defining element of this week. Your logic regarding discount rates and future cash flows is mathematically sound, but only in a vacuum.
Right.
And markets do not operate in a vacuum. The reason the tech sector didn't rally is because the market's discount mechanism was violently overwhelmed by an external supply shock.
The Middle East?
Yeah. Just as the algorithmic trading models were digesting this disinflationary relief, a severe military escalation in the Middle East fundamentally altered the risk environment.
We're talking about the Strait of Hormuz blockade.
Yes. We have to look at the timeline of how this external shock developed. Over the weekend and rolling into Monday, July 13th, Tehran targeted U.S. facilities across multiple Gulf nations and took the drastic step of declaring the Strait of Hormuz closed to maritime traffic.
And for anyone who doesn't track global maritime choke points, we really need to emphasize the sheer physical reality of the Strait of Hormuz.
It's critical.
It isn't just a shipping lane, it is the jugular vein of global energy transit. It's this narrow strip of water, about 21 miles wide at its narrowest point, separating Iran and Oman.
Right.
Roughly 20% of the world's total global oil consumption passes through that specific bottleneck every single day.
20%.
Yeah, you cannot easily reroute that volume of crude via pipelines. If that strait is blocked, the global energy supply is immediately and physically restricted.
It is the single most critical vulnerability in the global commodities market. And the U.S. response was immediate. On Monday, in direct retaliation, the U.S. military launched strikes against 140 targets inside Iran.
Wow.
From a market perspective, this immediately spiked global anxiety. Portfolio managers suddenly had to factor an extreme geopolitical risk premium into their asset pricing models.
Okay, so that was Monday.
Right. Now, the complexity of the week deepened on Tuesday because we saw a sudden, albeit brief, shift in rhetoric.
The de-escalation chatter?
Exactly. There was diplomatic chatter suggesting de-escalation, which coincidentally hit the news wires right around the same time as that stellar 0.0% core CPI report.
So for a brief moment on Tuesday, the market thought it was getting the best of both worlds, right? Peace in the Middle East and cooling inflation at home.
which stabilized global equities temporarily. But the relief was entirely illusory.
Because it didn't last.
Not at all. By Wednesday, the conflict intensified again, and the U.S. responded by reimposing a strict naval blockade. The situation just continued to deteriorate through Thursday and Friday, with fresh strikes and new threats expanding to Red Sea shipping lanes.
So going back to my earlier analogy, it really is like finding out your cholesterol is perfect while watching your car burn in the parking lot.
It's the perfect analogy.
The geopolitical crisis essentially neutralized the positive inflation data because the physical threat to global energy supply overrides domestic monetary policy. I mean, an asset manager cannot confidently price in a soft economic landing when the fuel required to run that economy might be choked off at the source.
Exactly. The macroeconomic setup became an unmanageable contradiction. You had textbook bullish data colliding head-on with textbook bearish geopolitical chaos. And when faced with that level of extreme uncertainty, capital seeks safety.
Okay, so we have this massive macroeconomic collision. How does that translate into the actual money moving through the equity markets?
Yes.
Because the capital didn't just evaporate.
No, it didn't.
It triggered a historic rotation beneath the surface of the major indices. We saw an incredible divergence in market capitalization, a genuine fall of the titans, coupled with a surprising sanctuary for the underdogs. Let's look at the weekly scorecards for the major benchmarks.
Yeah, the cap-weighted indices suffered significantly. The S&P 500 closed the week down 0.77%. The Dow Jones Industrial Average retreated 0.67%.
But the Nasdaq.
Right. The absolute epicenter of the selling pressure was the Nasdaq Composite, which took the hardest hit, closing down 1.36% for the week.
And the sources detail that this was not, a slow, steady bleed over 5 days. Thursday and Friday featured a very sharp, highly concentrated sell-off targeting mega-cap artificial intelligence and semiconductor stocks.
A brutal couple of days.
We are talking about the untouchable darlings of Wall Street taking a beating. NVIDIA, Alphabet, Netflix, Micron, TSMC.
To understand why these specific companies were targeted for liquidation, we have to examine the concept of being priced for perfection.
Okay, break that down for us.
These high-valuation growth engines have spent the last 18 months expanding their price-to-earnings multiples based on the promise of an artificial intelligence revolution.
Right.
When a stock is trading at 40 or 50 times its forward earnings, any macro hiccup causes multiple compression.
Okay, let's explain multiple compression for the listener. If you are paying $50 for every $1 of earnings a company makes, you are paying a massive premium because you assume those earnings will grow exponentially.
Right, you're buying future growth.
But the moment a geopolitical shock threatens global growth, you suddenly aren't willing to pay $50 for that $1 of earnings anymore. You might only be willing to pay $30.
Exactly.
The company's actual profits haven't changed yet, but the premium you are willing to pay for them compresses. The stock price plummets simply because the market's risk appetite evaporated.
That is a highly accurate mechanical explanation. When the geopolitical risk in the Middle East spiked, institutional investors looked at their portfolios, saw massive, unrealized gains in these AI-adjacent names, and realized they were overly exposed to high-beta assets.
They needed to cash out.
Yeah, selling those names was the most logical mechanism to take profits, raise cash, and aggressively reduce portfolio risk. Furthermore, the sources explicitly note that this tech correction was amplified on Friday by disappointing corporate growth outlooks released by several tech firms.
Oh, so it wasn't just abstract fear of the Middle East conflict. There was actual fundamental weakness creeping into the tech sector's own narrative.
Exactly. And the structural impact on the broader market is critical to grasp here. When we analyze the GICS sector summary, that's the global industry classification, Standard Technology was definitively the worst performer of the week, declining 3.14%.
Wow, 3.14%.
Yeah, and because indices like the S&P 500 and the Nasdaq are market cap weighted, the largest companies dictate the direction of the index. If Apple, Microsoft, and NVIDIA make up roughly 20% of the S&P 500's total weight, a 3% drop in the tech sector acts like a massive anchor.
It just drags the whole thing down.
It drags the entire index down, effectively masking any underlying strength in other areas of the economy.
And that masking effect leads us to the most surprising data point of the week. While the Nasdaq was bleeding out and the mega-cap tech stocks were dragging the S&P 500 into the red, small-cap stocks were actually thriving.
They were.
The Russell 2000, which tracks 2,000 small-cap domestic companies, actually gained 0.31% for the week. I need you to reconcile this for me.
That sounds crazy, right?
Yeah. It really does. If the most powerful tech companies in the world are crashing, and there is a massive military conflict threatening global energy supplies, Why on earth are small, vulnerable companies surviving? Are small caps somehow immune to war in the Middle East?
Well, they are not immune, obviously, but their capital structures and revenue models are fundamentally different from multinational tech giants. This speaks directly to the mechanics of capital rotation.
Okay.
When asset managers sold out of their massive tech positions, they didn't just move everything to cash. They engaged in sector rotation. They actively moved that capital into cyclical and defensive sectors that benefit from the specific data points we saw this week.
So think of the market like a highly complex, closed-loop plumbing system.
Yes.
When you suddenly close a massive valve-like asset managers dumping billions of dollars of mega-cap tech stocks that high-pressure water that capital, it doesn't just disappear. It forces its way into other pipes in the system. The pressure has to find an equilibrium.
That pressure valve analogy is perfect for understanding the Russell 2000's performance. Small caps are generally highly domestic focused. They derive the vast majority of their revenue from within the United States.
So it means what exactly?
It means they are far less exposed to international supply chain disruptions or foreign currency fluctuations than a massive multinational like Apple or Google. But the real mechanical advantage for small caps this week was the inflation data.
How does 0.0% core CPI disproportionately help a small company over a large one?
It all comes down to debt structures. Large-cap tech companies often secure long-term fixed-rate debt. Small-cap companies, conversely, rely much more heavily on floating-rate debt and short-term bank loans.
Ah, okay.
Therefore, small caps are hypersensitive to interest rates. When the CPI data came in so cold, the market immediately priced in a higher probability of Federal Reserve rate cuts.
Right.
For a small-cap company with floating-rate debt, a rate cut directly and immediately reduces their interest expenses, instantly boosting their profit margins. So the capital rotating out of tech actively sought out these rate-sensitive small caps.
That makes a ton of sense. The capital also forced its way into specific defensive and cyclical sectors. Our sources show real estate was up 1.61%, energy was up 1.66%, and consumer staples gained 0.71%.
Right, and if we examine the underlying catalysts for each, the logic of the rotation becomes transparent. Real estate is an incredibly rate-sensitive sector.
Because of mortgages.
Exactly. Similar to small caps, cooling inflation implies lower future interest rates, which translates to cheaper mortgages and reduced borrowing costs for commercial developers, making the sector instantly more attractive.
Then energy.
The energy sector's 1.66% gain is a direct mechanical reaction to the Strait of Hormuz blockade. Restricted oil supply forces the underlying commodity price up, expanding the profit margins of energy producers.
Okay, but I want to zero in on consumer staples gaining 0.71%. That's your grocery store chains, household products, toothpaste, toilet paper. In a week dominated by AI corrections and naval blockades, why is capital flowing into toothpaste?
Because consumer staples function as the market's ultimate defensive sanctuary.
Sanctuary.
Yes. When macroeconomic uncertainty reaches a fever pitch, portfolio managers rotate into companies that provide inelastic goods, products that consumers are forced to buy regardless of economic conditions or geopolitical crises.
Right, a consumer might cancel their cloud storage subscription or, delay buying a new semiconductor-powered smart appliance if the economy falters, but they will not stop buying food or basic hygiene products.
Exactly. For the listener managing their own portfolio, this week perfectly demonstrated why having exposure to staples acts as a vital shock absorber. It protects your capital when high-beta growth stocks violently correct.
So if capital is flowing like water through these pressure valves out of tech and into small caps and defensive staples, we still haven't accounted for all of it.
No, we haven't. Trillions of dollars shifted this week.
Right. To see the full picture, we have to look away from equities entirely. A massive wave of that capital flooded into the commodities and fixed income markets, creating some highly unusual volatility patterns. Let's tackle the energy markets first, because the physical commodities were aggressively repricing risk.
The global raw materials markets experienced intense supply-side volatility driven entirely by the physical constraints in the Middle East. The Bloomberg Commodity Index, which tracks a broad basket of global commodities, rose 1.89% for the week.
But the real action was in oil.
Yes. The localized epicenter of the pricing surge was, unsurprisingly, crude oil. IC Brent crude, the global benchmark, surged 5.76% to close at $82.10 a barrel.
Wow.
And West Texas Intermediate, or WTI crude, the U.S. benchmark, surged 5.57% to close at $82.49.
The catalyst there is straightforward. The naval blockade in the Strait of Hormuz directly restricts the volume of oil tankers reaching the open ocean. It is a physical disruption of supply meeting constant global demand, so the price mechanically has to rise.
It has to, yeah.
But here's the blind spot that I find absolutely fascinating. While crude oil was skyrocketing nearly 6%, Henry Hub natural gas barely moved.
It really didn't.
It inched up only 0.48% for the week, closing at $2.91. If you're an investor who tried to front-run the Middle East conflict by buying U.S. natural gas ETFs, assuming all energy commodities move in tandem during a war, you probably spent the week scratching your head as to why you weren't making money. Why did this massive decoupling between oil and natural gas happen?
That decoupling highlights the critical difference between globalized markets and localized markets. Crude oil is a highly fungible, globally integrated market.
Meaning it's easy to move around.
Yes, because oil is relatively easy to pump onto a tanker and ship anywhere in the world. A disruption in the Middle East instantly and mechanically impacts the price of a barrel of oil in London, New York, or Tokyo. Natural gas, however, particularly the Henry Hub benchmark, which prices the North American market, is much more localized.
Because transporting natural gas across oceans is a logistical nightmare compared to liquid crude oil.
Precisely. To move natural gas globally, you require complex liquefied natural gas, or LNG, infrastructure. You have to cool the gas to negative 260 degrees Fahrenheit, load it onto specialized cryogenic vessels, sail it across the ocean, and then regasify it at a specialized terminal.
You can't just throw it in a barrel.
No, you cannot easily or rapidly redirect domestic natural gas to solve an international energy shortfall. But the specific reason Henry Hub barely reacted this week, despite the global energy panic, was due to overwhelming domestic fundamentals.
Our sources indicate massive inventory surpluses in the U.S.
Yes. The United States currently has such an immense glut of natural gas sitting in domestic storage caverns that it completely capped any weather-related pricing premiums for North American power generation.
It's just sitting there.
Right. That massive domestic inventory acted as an impenetrable firewall, completely insulating the U.S. power grid, and by extension, the Henry Hub pricing, from the overseas oil shock.
It is a stark reminder that macro shocks do not impact all commodities uniformly. You cannot trade commodities on newspaper headlines. You have to understand the underlying physical infrastructure and inventory levels.
Absolutely.
Now, let's pivot the capital flow analysis to the bond market, the fixed income side of the equation. On Monday, right as the military strikes were initiating in the Middle East, we had a massive corporate debt issuance.
We did.
Amazon came to the market with an unexpected $25 billion corporate bond offering. Let's pause on that. Why does it matter to the broader market when one tech company borrows money?
It matters because of the sheer scale. $25 billion is a massive absorption of market liquidity. When a corporate whale like Amazon issues that much debt, it creates a gravitational pull on the entire fixed income ecosystem. It immediately pressures investment-grade corporate bond spreads.
Okay, let's explain the mechanism of a bond spread in this context. If I'm a mid-sized corporation trying to issue debt on the same day Amazon drops a $25 billion offering, what happens to me?
Okay, so a bond spread is essentially the extra yield, or the interest rate, a corporate bond must pay investors above the risk-free U.S. Treasury rate to compensate for the risk of default.
Okay.
When Amazon suddenly floods the market with $25 billion in new, highly rated bonds, investors have a massive new supply of safe debt to buy. If you are that mid-sized corporation trying to borrow money on the same day, investors will ignore your bonds unless you sweeten the deal.
Right.
You are forced to widen your spread, meaning you have to offer a higher interest rate to attract buyers away from Amazon. Amazon's massive issuance mechanically forced a repricing of risk across the corporate debt spectrum.
So corporate debt became more expensive to issue for everyone else. But despite that localized pressure in the corporate sector, the foundational bedrock of the bond market U.S. Treasury yields actually cooled off over the week.
They did.
The 10-year Treasury bond yield dropped 1.58% to close at 4.545%. The 2-year Treasury yield dropped 2.13% to close at 4.172%. If you remember the inverse relationship between bond yields and bond prices, dropping yields means bond prices were going up. Investors were buying treasuries.
Which tells us exactly what the smart money in the bond market was focusing on. While equity investors were panicking over AI valuations and Middle Eastern blockades, bond investors were reacting almost exclusively to the inflation data.
The CPI and PPI reports?
Yes. The cool CPI and PPI reports gave the bond market high conviction that the Federal Reserve would not need to keep interest rates higher for longer. Consequently, government bond yields steadily retrenched from their early summer peaks. U.S. Treasuries acted as the ultimate safe haven, absorbing the capital fleeing the equity markets.
And speaking of panic versus safety, this brings us to what I consider the most illuminating data point from the entire week, the volatility decoupling.
Oh, this is fascinating.
I want to look closely at two specific metrics. First, the VIX. The VIX is the stock market's fear gauge. Mechanically, it measures how much implied volatility options traders are pricing into the S&P 500 for the next 30 days. This week, the VIX spiked 9.38%, closing at 18.77.
Right.
That makes total logical sense. Stocks are falling. Tech is undergoing a structural correction. There's a naval blockade in the Middle East. Equity options traders are buying protection, so implied volatility goes up.
It is a textbook inverse correlation. When the S&P 500 index experiences rapid downward momentum, the VIX invariably spikes as portfolio managers hedge their downside risk.
But then you look at the MOVE index. The MOVE index is essentially the VIX for the bond market. It measures implied volatility in U.S. Treasuries, and the MOVE index actually dropped 8.86% this week.
Yeah, it dropped almost 9%.
Let that sink in. Equity investors are running around with their hair on fire, bidding up the VIX, while bond investors are sitting back, absorbing the data, and enjoying a massive drop in volatility. How does an intelligent investor synthesize that total disconnect?
That decoupling between the VIX and the MOVE index is rare, but it perfectly maps the underlying psychology of the market right now. If we examine the mechanics of what each market cares about, the disconnect makes total sense.
Okay.
Equity investors were panicking over specific growth-inhibiting threats: stretched AI valuations, disappointing corporate revenue outlooks, and the very real threat that a spike in energy prices would destroy corporate profit margins.
Exactly. Equities care about future earnings, and war destroys earnings.
Correct. But bond investors are not primarily concerned with NVIDIA's profit margins or tech sector capex. Bond investors are maniacally focused on inflation and Federal Reserve monetary policy.
And the inflation data was perfect.
Exactly. The inflation data we received on Tuesday and Wednesday, that flat 0.0% core CPI, was so definitively cool that it provided massive structural stabilization to the fixed income market.
So they weren't worried about the Middle East.
Not to the same degree, no. Bond traders looked at the data and concluded that the Fed's path toward rate cuts is now clearer than it has been in months, regardless of the chaos in the equity markets or the Middle East. Because their core variable inflation stabilized, bond volatility collapsed, even as equity volatility spiked.
It is a brilliant illustration of why cross-asset analysis is non-negotiable. If you only look at the stock market, you see panic. If you look at the bond market, you see clarity.
And furthermore, our sources point out that the nature of the equity sell-off was confirmed by the Shiller PE ratio data.
The Shiller PE?
Yes, the cyclically adjusted price-to-earnings ratio. It takes a company's price and divides it by the average of its earnings over the last 10 years, adjusted for inflation. It acts as a valuation shock absorber, stripping out the noise of short-term business cycles. This week, the trajectory of the S&P 500's decline demonstrated near-perfect linear cracking with the Shiller PE ratio.
Meaning what, in practical terms?
It mathematically proves that the equity sell-off was fundamentally a valuation correction. Investors weren't just blindly dumping stocks in a panic, they were systematically adjusting valuations downward to align with historical norms after the AI hype had pushed multiples too high.
It was rational.
Yes, it was a rational repricing of risk, independent of the short-term VIX fluctuations.
So as the closing bell finally rang on Friday, leaving a battered mega-cap tech sector, a surging oil market, and a triumphant bond market in its wake, Wall Street's attention immediately snapped to the forward horizon.
Next week.
Yes, we have to look at the upcoming week, July 20th to July 24th, 2026. The defining question for the listener is this. Was this week just a temporary, healthy rotation to bleed the froth out of tech valuations, or are we witnessing the leading edge of a broader systemic market crash?
Institutional strategy desks are viewing the upcoming week as a vital proving ground. The stakes could not be higher for market sentiment right now. The sources outline 3 primary thematic pillars that will define the trading environment for the week of July 20th.
Let's start by unpacking Pillar 1, the earnings avalanche. Specifically what the sources are calling the Magnificent Seven test. The calendar for next week is absolutely packed with heavy hitters.
It really is.
On Tuesday, we have Northrop Grumman and D.R. Horton. On Wednesday, the True Giants report. Alphabet, which is Google, Texas Instruments, ServiceNow, and CSX. And on Thursday, the gauntlet continues with Intel, Union Pacific, Norfolk Southern, Lockheed Martin, and RTX.
We are transitioning from the financial sector's early earnings reports directly into the core growth engines of the broader market. And institutional analysts have developed highly specific, unforgiving scorecards for these companies. The margin for error is effectively zero.
Let's drill down into Alphabet GOGL reporting on Wednesday. After the massive tech multiple compression we just witnessed, what specific metric is Wall Street hyper-focused on for Google?
For Alphabet, the entire narrative hinges on the return on investment for artificial intelligence. Over the past several quarters, Alphabet has been directing massive amounts of capital expenditure CapEx toward building out AI infrastructure, purchasing GPUs, building data centers, securing power generation.
Right.
Wall Street wants concrete proof. Are those massive AI capital expenditures generating actual, meaningful revenue acceleration in Google Cloud?
They want to know if anyone is actually paying for the AI or if Google is just building very expensive toys.
Exactly. Is this capital generating a return, or is it just burning cash and dampening free cash flow? If Alphabet fails to show a clear line of sight to AI monetization, the punishment from the market, especially following this week's tech correction, will be severe and immediate.
What about ServiceNow reporting the same day? They are a massive player in enterprise software.
The theme is identical. ServiceNow operates with high margins by selling workflow software to large corporations. Analysts will be aggressively scrutinizing their enterprise renewal and adoption rates.
To see if companies are still paying.
Yes. They need to verify that there is sustained, real-world corporate demand for operational AI integration. The market wants proof that companies are actually using and paying for these AI tools to improve efficiency, not just experimenting with them.
Okay, then on Thursday, we get Intel. Intel is a fascinating case study because they have been attempting a massive, highly capital-intensive reinvention for years.
Intel serves as a crucial barometer for the entire semiconductor space, but for a very specific reason. Unlike NVIDIA, which just designs chips, Intel actually manufactures them.
They own the factories?
Yes, the fabs. Investors are looking for concrete proof of execution in Intel's internal foundry business. They want a transparent timeline indicating exactly when Intel's massive government-backed fabrication scale-up will transition from burning capital to generating sustained profit.
Because the patience is running out.
With competitors like TSMC pulling further ahead, the market's patience with Intel's turnaround narrative is wearing extremely thin.
It is going to be an absolute gauntlet for the tech sector. But the earnings calendar isn't just tech. You mentioned Texas Instruments on Wednesday. Why is an older chip company so important to the broader macro picture?
Texas Instruments is widely considered the ultimate cyclical indicator for the physical economy. They specialize in analog semiconductors.
The basic chips.
Right, the basic chips that go into automobiles, industrial machinery, and consumer electronics. The industry has been suffering through a prolonged period of inventory destocking, where companies were burning through stockpiled chips rather than ordering new ones.
Right.
Investors are parsing Texas Instruments' earnings to see if that auto and industrial destocking cycle has officially bottomed out. If it has, it signals a broader cyclical recovery in manufacturing demand.
Speaking of the physical economy, we also have the major transports reporting next week. CSX on Wednesday, followed by Union Pacific and Norfolk Southern on Thursday. There's an old Wall Street adage, the Dow theory, which suggests that if the railroads aren't moving boxes, the broader economy isn't actually growing.
Transports are the undeniable pulse of physical commerce. For CSX, analysts are analyzing intermodal volume trends to gauge the baseline health of consumer demand across the eastern United States.
And for Union Pacific?
For Union Pacific, the critical focus is operational efficiency. Can they maintain their core operating margins despite the cascading delays caused by ongoing maritime shipping disruptions? And for Norfolk Southern, the market wants proof of structural margin improvements and strict cost controls following their recent internal operational overhauls.
So that is Pillar 1, the earnings gauntlet. Pillar 2 and 3 revolve around geopolitical spillover and macro stabilization. The actual economic data calendar is relatively light next week. We have initial jobless claims on Thursday and the S&P Global Manufacturing PMI alongside new home sales on Friday.
That light macroeconomic calendar is highly significant. Because there are no massive inflation reports or Fed rate decisions next week, the market's primary focus shifts completely away from the Federal Reserve and lands squarely on corporate execution and the ongoing geopolitical risk in the Middle East.
Let's look at the data we do have. Initial jobless claims on Thursday has a consensus expectation of 211,000, up slightly from 208,000. And the manufacturing PMI on Friday has a consensus of 54.5, which indicates steady expansion.
Right.
But here's the challenge for the listener trying to build a strategy. How does an intelligent investor synthesize this massive earnings avalanche against the backdrop of an active, escalating geopolitical crisis?
It's difficult.
But let's look at Thursday as a prime example. We have Intel, a cyclical tech turnaround play, reporting on the exact same day as Lockheed Martin and RTX, two of the largest global defense contractors. If I am an asset manager, do I bet my capital on Lockheed Martin because the Strait of Hormuz is locked down by military vessels? Or do I bet on Texas Instruments and Intel because the domestic chip cycle is bottoming out? How do you weigh those contradictory forces?
That synthesis is the exact dilemma portfolio managers are wrestling with over the weekend. Commodity strategists and global macro hedge funds are entering the week of July 20th with acutely heightened sensitivity toward the Middle East. They are actively and aggressively pricing the Strait of Hormuz risk premium into their asset allocation models, adjusting their weightings as the military blockade physically reshapes global supply lines.
Which means defense stocks like Lockheed Martin, RTX, and Northrop Grumman are going to be under an intense microscope.
Absolutely. The market expects these defense contractors to translate global instability into top-line revenue. For Lockheed Martin, Wall Street expects firm updates on delivery timelines for flagship programs like the F-35 fighter jet.
They need to see the execution.
Right. They need assurance that heightened global defense spending is flowing smoothly through the supply chain. For RTX, investors are closely watching commercial aerospace aftermarket demand to confirm that it can offset the logistical frictions occurring in their defense layers. And on Tuesday, Northrop Grumman faces a similar test. Can they expand their profit margins despite the ongoing supply chain bottlenecks plaguing the aerospace industry?
But the takeaway here isn't just to blindly buy defense stocks and call it a day, right? That seems too simplistic for the current market plumbing.
It is entirely too simplistic. The strategy heading into next week requires a highly surgical approach to capital allocation. The era of buying a broad, cap-weighted index and letting passive momentum inflate your portfolio is firmly paused.
Okay, so what is the actionable guidance?
The actionable guidance for listeners navigating this environment is to aggressively seek out companies demonstrating two specific traits: ironclad operational efficiency and definitive pricing power.
Let's define pricing power mechanically. In an environment where a geopolitical shock is causing energy input costs to spike, a company with pricing power can simply raise the price of their product to cover the higher energy costs, and their customers will still buy it.
Right, they pass the cost along.
But a company without pricing power tries to raise prices and completely destroys consumer demand, crushing their margins.
Precisely. You have to look past the surface-level momentum of the indices and deeply examine the fundamental resilience of individual corporate balance sheets. Can the company pass on the costs of inflation and supply chain friction without losing its customer base? If the answer is yes, that company is a viable target for capital rotation.
That structural reality brings us perfectly to the essential lessons of this absolutely wild week of July 13th to 17th. If we have to distill the core insights for our listeners, it is that the market is undergoing a profound structural shift.
It really is.
The valuation tug-of-war we discussed at the top of the show is actively forcing capital out of the crowded, overvalued mega-cap tech trade. That capital is being forced through the pressure valves into areas of the market that offer either fundamental value, like small caps, or defensive safety, like consumer staples and government bonds.
It is a market environment that is suddenly and violently demanding proof. It demands proof of AI revenue monetization. It demands proof of supply chain resilience in the face of naval blockades. And above all, it demands proof of valuation.
Fundamental valuation and intelligent sector positioning are back in the driver's seat. The macroeconomic forces, the collision of domestic disinflation and international supply shocks are simply too violent right now to rely on passive index-level momentum. You have to know exactly what is inside your portfolio and why it is there.
Which leaves us with a rather provocative question to ponder as we head into next week's trading sessions.
I love a provocative thought to end on. What should we be thinking about?
Well, for the last decade, retail investors and institutions alike have been taught that passive index investing, simply buying a total market ETF or an S&P 500 index fund and holding it forever, is the safest, most prudent way to invest.
It's the ultimate set it and forget it strategy.
Exactly. But consider the mechanics of what we just discussed. Those cap-weighted index funds are overwhelmingly weighted toward the exact mega-cap technology stocks that are currently undergoing a severe structural valuation correction. Meanwhile, the specific sectors that provided safety, shelter, and positive returns this week, the small caps, the defensive staples, the energy producers, make up a drastically smaller percentage of those passive funds.
So by holding the safest index fund, you are structurally underweighting the exact assets that protect you during a rotation.
That is the core question. In this highly specific rotational phase, characterized by intense physical geopolitical energy shocks and the bursting of an AI valuation bubble, could the safest traditional investment strategy, passive index investing, actually be the absolute riskiest place to park your capital? Are passive investors mathematically blind to the very capital rotation that could protect their wealth?
That is a fascinating and honestly somewhat chilling thought for anyone relying entirely on a target date index fund for their retirement. It really emphasizes why understanding these deep cross-asset market currents is so vital. We simply cannot rely on the surface-level momentum to carry us through complex macro collisions. You have to understand the mechanics of the machine.
You really do.
Well, that wraps up our analysis for this incredible week in the markets.
Thanks for having me.
If you enjoyed Wall Street Weekly's market analysis, subscribe and leave a comment or review wherever you listen to your podcasts, and follow us, Wall Street Weekly, on YouTube so you never miss a market update. We will be back next week with more weekly insights and analysis from Wall Street. Thank you for listening.